Investment in shares. Investing in shares, also known as stocks, can be a great way to grow your wealth over time. When you buy shares in a company, you essentially become a part owner of that company and have a stake in its success. If the company does well, the value of your shares can increase, and you may also receive dividends. Here are some things to consider before investing in shares. Understand the risks. Investing in shares comes with risks, including the possibility of losing money. It's important to understand the risks involved and to have a plan in place for managing them. Research the company before investing in shares. It's important to do your research on the company you're interested in. Look at its financial statements, earnings reports, and any other relevant information that can help you make an informed decision. Diversify your portfolio. Don't put all your money into one company or industry. Diversifying your portfolio can help reduce risk and improve your chances of success. Consider the fees. When you buy and sell shares, you'll likely have to pay fees to a broker or online trading platform. Be sure to factor these fees into your investment plan. Invest for the long term. Investing in shares is not a get-rich-quick scheme. It's a long-term strategy that requires patience and discipline. Be prepared to hold onto your investments for several years to see the best returns. Overall, investing in shares can be a great way to build wealth over time, but it's important to do your research and have a solid plan in place. Understand the risks. Before investing in shares, it's important to understand the risks involved. Here are some key risks to consider. Market risk. Share prices can fluctuate due to market conditions, economic events, and other factors beyond the control of the company. This means that the value of your shares can go up or down, and you may lose money if you sell your shares during a downturn. Company risk. The performance of a company can also impact the value of its shares. Factors such as changes in management, competitive pressures, and regulatory changes can all affect a company's financial health and prospects. Industry risk. Investing in shares of companies in a single industry can be risky. If that industry experiences a downturn, all the companies in that industry may suffer, and the value of your shares could decline. Liquidity risk. Shares can be difficult to sell quickly if there are no buyers in the market. This can be especially risky if you need to sell your shares quickly to raise cash. Currency risk. If you invest in shares denominated in a foreign currency, fluctuations in exchange rates can affect the value of your investment. Political risk. Political events such as changes in government policy, geopolitical tensions, and trade disputes can all affect the value of shares. It's important to consider these risks and to have a plan in place for managing them. This can include diversifying your portfolio, investing for the long term, and keeping a close eye on market conditions and company performance. Research the company. When investing in shares, it's important to research the company you're interested in to help you make an informed decision. Here are some key things to consider when researching a company. Financial statements. Look at the company's financial statements, including its balance sheet, income statement, and cash flow statement. This will give you a sense of the company's financial health and how it's performing. Earnings reports. Read the company's earnings reports to see how it's doing compared to its competitors and whether its revenue and profits are growing. Management team. Look at the company's management team to see whether it has a track record of success and whether its leaders have experience in the industry. Competitive landscape. Understand the company's competitive landscape, including its competitors, market share, and industry trends. Regulatory environment. Consider the regulatory environment in which the company operates and whether any regulatory changes could impact its operations. Valuation. Look at the company's valuation, including its price-to-earnings ratio, to determine whether the stock is overvalued or undervalued compared to its peers. Analyst coverage. Read reports from analysts who cover the company to see what they think about its prospects. Company news. Keep up to date with any news or announcements from the company, including new products, partnerships, or changes in management. By doing thorough research on a company, you can make a more informed decision about whether to invest in its shares. Diversify your portfolio. Diversifying your portfolio is an important strategy to help reduce risk when investing in shares. Here are some key ways to diversify your portfolio. Invest in different sectors. Invest in shares of companies in different sectors such as technology, healthcare, energy, and consumer goods. This can help you spread your risk across different industries and avoid overexposure to any one sector. Invest in different geographies. Consider investing in shares of companies based in different countries and regions. This can help you avoid the risks associated with a single country or region. Invest in different market caps. Consider investing in shares of companies with different market capitalizations, including large cap, mid cap, and small cap companies. This can help you spread your risk across companies of different size. Use index funds or ETFs. Consider investing in index funds or exchange-traded funds (ETFs) that track a broad market index. This can help you diversify your portfolio across many companies and sectors. Rebalance your portfolio. Regularly review your portfolio and rebalance it as needed to ensure that your investments are still diversified. This can involve selling some shares and buying others to maintain a balanced portfolio. By diversifying your portfolio, you can help reduce your risk and improve your chances of success when investing in shares. Consider the fees. When investing in shares, it's important to consider the fees associated with the investment. Here are some common fees to keep in mind. Brokerage fees. When you buy or sell shares, you'll usually pay a commission to your brokerage firm. The commission can be a fixed dollar amount or a percentage of the trade value. Account fees. Some brokerage firms charge annual fees for maintaining your investment account. Management fees. If you invest in a mutual fund or exchange-traded fund (ETF), you'll pay management fees to the fund manager. These fees can vary depending on the fund and are usually a percentage of the fund's assets. Expense ratios. In addition to management fees, mutual funds and ETFs charge expense ratios to cover the costs of running the fund. These fees are expressed as a percentage of the fund's assets. Trading fees. Some mutual funds and ETFs charge fees when you buy or sell shares in the fund. These fees can be a fixed dollar amount or a percentage of the trade value. It's important to consider these fees when investing in shares as they can eat into your returns over time. Be sure to read the fine print and understand all the fees associated with your investment before making a decision. You can also compare fees between different brokerage firms and investment options to find the best option for your needs. You can also compare fees between different brokerage firms and investment options to find the best option for your needs. Invest for the long term. Investing for the long term is a key strategy when investing in shares. Here are some reasons why. Time horizon. Investing for the long term allows you to ride out short-term market fluctuations and benefit from the long-term growth potential of the stock market. Compounding returns over time. The returns you earn on your investments can compound, meaning you earn returns on your initial investment plus any returns earned in previous periods. Reduced trading costs. Frequent trading can increase your trading costs and potentially decrease your returns. By investing for the long term, you can reduce your peace of mind. Investing for the long term can help you avoid the stress and anxiety that can come with constantly monitoring your investments and reacting to short-term market movements. When investing for the long term, it's important to have a diversified portfolio and to regularly review and rebalance your investments as needed. By investing for the long term, you can increase your chances of achieving your financial goals and building wealth over time.